Next is I have to look at my phone because I wrote it down. Um, Volume composition and true order flow markets. So we know that markets aren't driven by patterns and price charts, but they're driven by order flow. There are a handful of markets you can effectively trade. Uh, the bonds, that is the treasuries, which is good for scalping. I've heard. I don't trade them. The ES, the indexes. So RTY, the Russell, YM, the Dow, ES, the big one, and NASDAQ, the faster one. Um, and then the commodities, that's gold, natural gas, and crude oil. Crude oil is probably your best bet. So we're talking about the indexes now. I've heard, oh yeah, what I meant to say is value composition. So the ES is specifically the ES specifically is a leveraged mirror of the S&P 500 index. So it follows the S&P 500, but it's a mirror with leverage in it. And the S&P 500 index is the top 500 companies in the US, right? So you have to ask where the flow is coming from, why it's going there, and what the composition is. It would be an oversimplification for me to tell you that um, somebody bought 19 market orders at 81.50 and that resulted in the price going higher, because that's not the case. this this is the difference now between what I'm calling a true order flow market and more of a correlative market is what I'm trying to describe. So the ES, the orders will pull, the market maker will pull the orders in the ES for multiple reasons. If the standard index moves up a tick or a point or like 25 cents or whatever, the ES also has to move up in lockstep. So an algorithm will pull its limit orders, because algorithms oftentimes communicate through limit orders, trade through them. They'll pull the limit orders to accommodate for the arbitrage. And then somebody comes in, and maybe something like 50% of the volume apparently on the futures markets are market makers hedging the legs in their options trades, which is new. That didn't used to be a thing. So first you have arbitrage between the index and the futures price. Then the second thing in flow is market makers and options. Then of course you have the retail investor who has a stop loss, who moves price around as well. Um, then you have people coming out to hedge general positions in the ES in order to offset risk on their book. So the ES functions more like a hedging instrument and isn't really designed to trend. I remember reading somewhere that during the day, like the ES goes sideways all the time, and at night it actually trends, which is pretty much, you know, what it does. Okay, so it's for people with real jobs to offset inventory, hedge out their positions so they can provide like real goods and services and all this. So that's where the flow is coming from. So it's not a true order flow market. There was something else, but you get the idea. Oh, and then there's the pricing in of financial news. So that's a mess. That's an order flow mess. That all those things are converging within each other. And then there's something to be said for correlations, because the Nasdaq is 95% correlated to the ES. So if I see the Nasdaq ripping and like I'm at 85 and somebody's getting absorbed here, they're trying to I'm at 85 and somebody's getting absorbed here. They're buying, trying to trace at the NASDAQ, and the NASDAQ is ripping and they get stuck at 85. That tells me that somebody needs to absorb here, or somebody's caught offside, or I'm going to take advantage of that information and trade off of it. I'm either going to go long or short. It depends on the situation. Um, and so correlations I just realized today that correlations are kind of a strong thing to determine value from, especially in the indexes. So I'm already in the ES. I'm not going to jump instruments. I'm just going to trade the ES until I'm profitable, and then if I want to, I'll move on from there. But that brings us to the second better markets to trade in general for the speculator, and those are true order flow markets where the primary amount of volume and I guess market consensus is found in the order flow rather than all this correlated nonsense, playing games with the market maker as they try to hedge and accommodate for the change in the underlying S&P 500. Right. So the indexes aren't as good. Order flow is good, but the indexes aren't as good for order flow because of that. Crude oil, completely flow driven. I mean, completely. Like, if somebody does something, it'll show up on the flow in crude oil. Gold is another one. There are like three major gold desks on the planet or something. Like one's in London, one's here in the States, and then one's in like Tokyo or something. And apparently, a good portion of the volume is speculator driven. The ags have real supply and demand, and I'm not interested in trading like beans and corn and whatever. And those are for people that hedge against their supply. Natural gas is another one, but natural gas is super, super volatile. It's also a high tick size. I mean, it's very easy to get burnt. I'm not even like we'll move up from there, right? Start with the easier ones and bonds. Bonds are very slow. Bonds are very slow, very thick, and very order flow driven. But more importantly, like the go to is crude oil for trading order flow, even if you're not scalping the DOM because it's flow driven and it trends more than the indexes. That's my piece.